original formula of assets equals liabilities plus owner's equity. We're sticking with that. That's not going to change. Um, Here I have a list of assets, and as we know, the normal balance for any asset would be a debit. So at the end of the month, bank is usually going to be a debit, receivables debit, supplies debit. So we have some of each of these, and they're going to be assets, and they're going to be on the debit side, on the left side. Liabilities, however, are going to be on the right side. So in our T accounts, anything that's a liability payable, the balance will typically be on the right side of our T account. For owner's equity, we've been saying, we've been letting you know about capital, and capital is usually on the right side, so it's credit. However, we're introducing three new accounts, so three new T accounts that you need to know about, just to break up the equity section to make it easier to understand. The first one, in no particular order, is revenue. So now, whenever we obtain revenue, whenever we sell something, whether it be a good or a service, we are going to credit revenue. We're no longer just going to credit owner's equity. We're going to break it down and call it revenue. So we're probably going to debit bank or receivables, right? So our cash or our receivables are going to go up. And because we debited those, something has to be credited, and that's going to be revenue. And when we credit revenue, it increases our overall equity, which is good. Now, on the other hand, if we have expenses, and by expenses I mean spending money on things that aren't assets. See, if we buy equipment, equipment goes up and cash goes down. Or supplies go up and cash goes down. Or payables will go up, right? But here, we're not buying anything. We're just spending money on stuff, whether it be utilities, payroll, gasoline, car expense. So now, if our bank or our payables, if our bank is going like down, then something has to happen on this side. So for spending money, okay, so now bank's going to be credited, something has to be debited on this side, right? And that's going to be expenses. So anytime you have an expense, when you're doing your journalizing, you're going to debit expenses. So the first entry will be either car expense or salary expense or wage. So that's going to be your debit from now on. It'll be whatever expense it happens to be. And your credit will probably be either bank or payables. The third one that we're introducing is drawings. Listen, the owners need to live as well. And typically, in a small business, the owner has to take money out of the business in order to live, to eat, right, to pay their own mortgage, etc. So when they take money out, we know that bank is going to be credited. What's going to be debited is drawings. Okay, so drawings and expenses will reduce the owner's equity. Okay, so those are the three new accounts. While we're on the topic, Simply Accounting is going to be asking you for the number of certain accounts, and here I've listed the numbers where they belong. So assets typically will be between 1,000 and 1,999. Liabilities such as payables, loan payables, those kind of things will be between 2,000 and 2,999. Anything that's either capital or drawings, the owner putting money in or taking money out, will be between 3,000 and 3,999. Any kind of a revenue, sales revenue, will be between 4,000 and 4,999, and expenses, all of them will be between 5,000 and 5,999. So these are the new accounts. These are the normal balances of all of your accounts.